How does a margin call actually work? Step by step, from the moment your account crosses the line to the moment your broker takes action. Most people hear margin call and picture a vague, scary phone call. That's not really how it happens anymore. It's mostly automated, it's mostly silent. And by the time you notice, the clock may already be running. Let's walk through the actual mechanism in order with real numbers. Step 1. You open a margin account and buy stock using borrowed money. Say you have $10,000 in cash. Under standard Reg T rules, a margin account typically lets you borrow up to the same amount again. That gives you $20,000 in buying power. You use all of it to buy 200 shares of $100 stock. You've put up $10,000 of your own money. Your broker has lent you the other $10,000. Step 2, your broker sets two separate thresholds. This is the part almost nobody explains clearly. There's the initial margin requirement. That's what you needed to open the position. That's already done. Then there's the maintenance margin requirement. That's a completely different number, and it determines whether you get to keep the position. Maintenance requirements are typically set around 25% of the position's current value. Many brokers set their own house requirements higher, sometimes 30 or 35%, especially on volatile stocks. Step 3. The stock price moves and your equity moves with it, but not in a straight line. Here's the number that matters. Equity is not the same as your position value. Equity is your position value minus what you owe the broker. Let's track this. Your position starts at $20,000, you owe $10,000. Your equity is $10,000, exactly half. Now the stock drops to $80 a share. Your 200 shares are worth $16,000. You still owe the broker $10,000 because that loan doesn't shrink just because the stock did. Your equity is now $16,000 minus $10,000, which is $6,000. Step 4. Your broker checks whether that $6,000 in equity still meets the maintenance requirement. This is where the math turns against you fast. At a 25% maintenance requirement, your broker needs your equity to be at least 25% of your $16,000 position. That comes out to $4,000. You have $6,000, you're still fine for now. But watch what happens with one more leg down. The stock drops again to $65 a share. Your position is now worth $13,000. You still owe $10,000. Your equity has fallen to $3,000. The required minimum at 25% of $13,000 is $3,250. Your equity at $3,000 is now below that line. This is the exact moment a margin call triggers, not when the stock drops a lot. The moment your equity, after subtracting the loan, falls below the maintenance percentage of your current position value. Step 5. The call gets issued, and this is almost always automatic now. Most major brokers run this check continuously throughout the trading day, not once at market close. The moment your equity crosses below the line, a margin call notification goes out, usually by email, app alert, or both, along with a specific dollar figure. In this example, you'd need to deposit at least $250 to get back above the line. Most brokers will ask for a bigger buffer than the bare minimum, since another small move could trigger the exact same call again tomorrow. Step 6. The deadline. This is where account agreements vary, and it matters more than people expect. Some brokers give you until the end of the next trading day. Some give you same day. Critically, and this is buried in the account agreement almost nobody reads, brokers reserve the right to liquidate part or all of your position without any advance notice at all, especially in fast-moving markets. You don't have a guaranteed grace period. You have whatever grace period your specific broker's house policy grants you that day. Step 7. If you don't act or can't act fast enough, the broker sells. They typically sell the minimum amount needed to bring your equity back above the maintenance line, not your entire position. In a fast decline, they may sell more to protect themselves against further movement. And here's the detail that stings the most. They choose what to sell and when, not you. You have no say in which position gets liquidated or at what price it gets sold. So what actually determines whether this happens to you, not whether you use margin? Whether you understand before you're in the position how much room exists between your entry price and the price where your equity crosses that maintenance line. That number is calculable in advance, with simple math, before you ever place the trade. Most people never calculate it. They find out where the line is by crossing it. If you want a rough rule of thumb, the math generally works out to this. The stock has to fall by roughly the percentage you originally borrowed, divided by a factor tied to your maintenance requirement, before you're at risk. In our example, borrowing half your position value, a maintenance requirement around 25%, meant the real cushion was smaller than a 50% drop. It was closer to a 35% drop. That's a meaningfully tighter margin of safety than most people assume when they see 50% buying power advertised on their trading app. Margin isn't dangerous because it's complicated. It's dangerous because the actual trigger point is closer than the marketing makes it feel. And because once you cross it, the timeline moves faster than most people expect and the decision stops being yours. Thank you for watching all the way through. If this made the mechanics of a margin call actually click, give this video a like and subscribe to the channel so you don't miss the next one.